Hi guys, welcome to part 2 of this video. The bull market continues. What next? So again, if you have not watched part 1, go look for part 1, watch part 1, and come back to part 2. Alright, so to find out where we're going from here, let's consult the charts. Let's look at the technicals. Alright, so over here we have got the S&P 500. You can see that's our big bear market, fastest bear market in history, and we dropped 36% down. Okay, so you can see this is the recent rally of the lows. Now, of course, many people were expecting that the bear market would continue down, right? So normally in a bear market or downtrend, it doesn't drop in a straight line. You have got what we call the impulsive wave down, the corrective wave up, and the next impulsive wave down. Now, this corrective wave up is also known as a bear market rally or a dead cat bounce. So normally after the market drops from A to B, it would rally to C before plunging further. And normally C would be usually a 38.2% retracement or a 50% retracement or a 61.8% retracement. These are the Fibonacci retracement levels. So let's take a look at these levels and let's see what happened. So let me just zoom in over here, use my Fibonacci tool. Again, if you've not learned Fibonacci, useful to learn in our stock trading course. So I'm going to click on A, drag to B. There we go, all right? So that's the 38.2% level, 50% and 61.8%. So initially when the market was going up, people were expecting that it's going to hit the 38.2% and go down. All right, sure enough, it hit it. And again, these levels act as strong resistance levels. So it hit that resistance, it came down, but it stopped there. And it formed a bullish engulfing pattern. So when it formed a bullish engulfing pattern, making higher lows, that was the clue that, hey, the bull market has begun, especially in the face of bad news, right? So whenever you hear a lot of bad news that, a lot of people are dying and recession, depression, but the market doesn't go down, it tells you the bear market has died. Because bear markets don't die on good news, bear markets die on bad news. Because when there's bad news and the market doesn't go down anymore, it tells you that there's no more sellers left. All the people who have wanted to sell out of panic have already sold. So the only people in the market left are the big institutional buyers, right? So that was a clue that the market was bullish, right? And then the market continued going up, and people were then watching the 50% level, and sure enough, it hit that resistance, and it came down slightly, but it then blasted back above that. So people expected 38.2% reversal, didn't happen, 50% reversal didn't happen. So what is the next level of resistance that we could potentially see a reversal down? Well, we are there, okay? So as you know, resistance can come in the form of moving averages or Fibonacci levels. So currently you can see the market as of Friday last week, we are right at the 50 moving average, the 50 simple moving average, and that could act as a resistance. So I'm not surprised that after this resistance, we could come down initially. Now, will we go all the way down or halfway down? I'll talk about it in a short while, so hang on to your horses, right? Now, but if it is able to break above the 50 moving average today, then the next resistance is the 61.8% level. Okay, so again, I'm watching two levels over here. Let me just draw it out. So first I'm watching tonight 2874 level, right? Could it break today's resistance? Remains to be seen. If it can break, the next resistance would be about 2935. Again, why 2935? Because that's a 61.8% Fibonacci level that could act as a resistance. And if it can break above that level, the next level will be all these moving averages. So you've got all these moving averages acting as a strong resistance at the 3000 level. So these are kind of like the brick walls that the market has to punch through to get all the way back up there. All right. Now, here's the thing. The market, even if it goes all the way back up, and beyond, to infinity and beyond, remember, it will not go up in a straight line. Nothing goes up in a straight line. So if you missed out getting in at the lows, no worries, there's still another chance for investors to get in. Like I said, I've bought most of my stocks already. My shopping cart is full. I'm not adding any more shares right now. So why am I not adding shares right now? Because remember, again, the wave patterns. As it goes up, you've got an impulsive wave up. It's like breathing out, right? You can't breathe out forever. You run out of air. You got to breathe in, corrective wave, breathe out, breathe in, breathe out. So always remember the wave patterns. As a smart trader or investor, when do we want to buy? Do we want to buy on the breathing out or the breathing in? That's right. We never want to buy on the breathing out, especially at the top. Trouble is most retail investors will get in here. They'll buy towards the end of the impulsive wave. Why? Because that's when all the news is great. People are saying, hey, great news is happening, economy is improving, right? There's a vaccine coming, And when they see a lot of people making money, they get confident, they jump in. The moment they jump in, guess what happens? That's right, the market will drop. Oh, and they panic and they sell. And that's why most retail investors lose money. So even though the stock market always goes up eventually, most people lose money because of their emotions, right? They buy high, they sell low. So to be a successful investor, you want to do the opposite of everyone else. So professional investors, when do we buy? That's right, we don't buy at the impulsive wave, we buy at the corrective wave. So we always wait for the market to correct down, right? And again, when does this happen? When you hear bad news. When you hear a lot of bad news, that's when the market's going down. That's when you want to buy. That's right, you buy on the bad news. But of course, you want to wait for it to come down to hit a level of support, like a Fibonacci level or a horizontal support level. So we want to buy there, and once it takes off, if you're a short-term trader, you can take profit somewhere there. But if you're a long-term investor, you can hold it for it to go and let your wealth compound over the years. So it's kind of like in a relationship, right? In a relationship, never chase the girl. When a girl is running, never chase the girl or the boy, depending on your sexual orientation, right? So never chase the girl. Always let the girl run to you. Let fear cause the girl to run to you into your arms, right? So never chase the girl, let the girl run to you. Always remember that. Same thing in the markets, right? So what's happening right now is the girl is already running away. So that's our impulsive wave up. That's our corrective wave down. And again, this was actually a Fibonacci level, right? So this was A, B, C. This was a Fibonacci level. Check it out. Let me just use my Fibonacci tool again. Well, let me just get rid of this one so you're not confused. That's the downtrend Fibonacci. Let's look at the uptrend Fibonacci, right? So A to B. Where's my B? Where's my B? There's my B. Okay, there we go. So check it out. Can you see 38.2% Fibonacci? Exactly at that level. All right, so A, B, C, Fibonacci, and then we hit that support. Now it's taken off all the way there. So the girl is running. Do we want to chase the girl? Do we want to buy the girl or the guy over there? No, we don't, right? So I'm waiting now for it to come back down. That's right. So temporarily, market's a bit overbought, like a rubber band stretched. It's got to snap back. It's got to snap back. Wait for the snapback to add shares, okay? Now again, we are waiting for the resistance. This could be the resistance today, or again, it could still go up slightly to this resistance. Remains to be seen. So we want to see a bearish candlestick pattern to signal reversal, okay? So once we got a reversal, once we got a reversal, we want to see the market coming down. And again, when it comes down, expect again bad news in the markets. Oh, more people are dying, businesses are going bust, so you get bad news, and it starts to come down. Now, where will it find support? Well, again, we can't predict the future, but these are the levels I'm looking at. So the first level I'm looking at is 2646. to find support. Why? Because that's the previous resistance that could become support, 2646. If I see a reversal candlestick pattern there, I'll start to add more shares. Or the market could in fact come back down to this previous low and in fact go below the low slightly and then reverse back up. That is my stronger guess that's going to happen. So why does this happen? We call this a forced double bottom. And this was taught to me by good friend Elson Chu, who is a master of market manipulation. Because he was a professional prop trader for many years, studying how market makers manipulate the markets, right? Market makers and brokers, guess what? They can see your stop loss. So a lot of people, they buy here, what do? They place their stop losses over there to protect them, right? Now, these big institutional buyers and market makers, they want to buy shares, but they want to buy it cheap. So what they do is they will find a way to short the market and release bad news, causing the market to go down and triggering these stop losses, forcing the poor retail traders to sell their shares at a low price. Who buys the shares? That's right, the market makers, the institutional buyers, they buy the shares when retailers are selling. Once they buy it, all right, and they will send it to the moon again. All right. So in other words, I'm watching this level 2365. If it hits that level, takes out the stop losses, and I see a reversal pattern like a bullish engulfing pattern or bullish pin bar, boom, I'm going to add more shares for the next ride all the way up. So to reiterate what I'm saying is yes, the market is going to come down. It's overbought. It's going to come down, all right? But it's not. But in my opinion, it's unlikely. Again, I can't predict the future, right? But my guess is unlikely the market is going to make a lower low than that bottom. Unlikely. Okay. Now, why? Again, it's not just a blind guess. It's because for the last 100 years, out of all the bear markets I have studied, every time the market has recovered more than 55% of the bear market losses, it has never made a new low. Let me repeat that statement. Every time the market has recovered more than 55% of the bear market drop, it tends to make all-time highs and it doesn't make a new low anymore. So if the market does indeed make a new low, it will be the first time in 100 years that it happened. So again, everything is possible, but unlikely it's going to happen unless there's a second big wave of viruses that hit the world, which could be a possibility. So you must always plan for eventualities. No matter what happens, you got to have a plan about what to do, right? But for now, my guess, we're going to find support anywhere from 2365, 2472. We're going to add more shares, have the chance to buy more for the next leg up. And my guess is by September or October this year, we should be at new highs in the market, or at least at a minimum at about 3,200 points. Okay, so let me show you some of the historical facts for you to make your own decisions. Okay, so let's take a look at all the bear markets since 1956. Now I can't do anything before that because TradingView doesn't have the data for me to look at, right? But this is the S&P 500. These are weekly candles. What I need to pay attention to is this green line. This is the 55% mark, which means after the drop, it recovers 55% of the bear market losses. Like I said, in history, every time the stock market is able to regain 55% of the bear market losses, it doesn't make a new low. It tends to make new highs. So let's check this out. So the top was here. This was again 1956. That was the top. And this red line here represents the 20% drop from the high. Because a bear market is defined as a 20% drop from the high. So once we see it crosses the red line, it's a bear market. Before that, it's not a bear market, right? So that's the top here. And in 15 months, you can see it hit 20% drop. Eventually, it went down 21% from the high. So this was a bear market. And once it hit that low, what happened? It went up, and you can see over here it closed above 55% of the initial drop. And once it closed above 55%, it never made a new low anymore. It made new highs. There we go, right? Now, some of you may say, but Adam, how about this, right? After it dropped here, didn't it recover more than 55%? Well, this is not counted. Why? Because this drop was not at least 20%. It's got to be at least a 20% drop for this rule to hold. Okay, so this was the 20% drop over there. Next, let's go on to 1962. That was the market top. That's the 20% mark. So in 6 months, the market dropped into a bear market over here, continued going down all the way to 30% drop. Now, what happened after that? That low was made, it went up, came down, went up, and over here you can see it closed again above the 55% mark, and hallelujah, away we go. New highs. Never made a new low. Next one, 1966. Market topped over here. Took 8 months to drop all the way to the bottom at minus 24%. Again, this represented the bear market. Okay. Now, again, notice that after it dropped, it rallied up, but it did not rally 55%. Okay. Then it dropped over here, went up, and over here you can see it closed above the 55% mark. Once it does, we are home free. Okay. If we can't close above 55%, go slower. Can't close above, go slower. Close above 55%, home free. That's based on history, of course. 1968, market top was over there. This was a long bear market. Took 17 months to bottom at minus 38%. Right, this was a 20% mark. Right, so once it hit this, we're in a bear market officially. Rallied, could not reach 50%, went down, rallied, and here closed above 50%. That's our mark over there, and again, we are home free. Again, notice something, right? After it closed, it did not go up in a straight line. It still went down. It still went down. So remember, you will always have a chance to get back into the markets during the breathing in, during the corrective wave. So there's always going to be a corrective wave. It will not go up in a straight line. Next one would be 1973, 1974. This was the year I was born, so I was too young to trade this. Unfortunately, I was only like 1 year old. Sorry, 0 years old, 0.5. That was the top. Took 20 months to reach the bottom. This is a 50% drawdown on my birthday. Can you imagine that, right? That was the 20% mark. So once it hit that, bear market, right? Again, rallied, could not reach 55%, went down, rallied, went down. Now over here, that's the 55% mark. So you can see we closed above 55%. Once we close, what happened? That's right. We made new highs over there. And again, notice it did not go up in a straight line, right? What happened? It went up, it went down, right? So it will have ups and downs. So expect more corrective waves. That's when you want to buy. That's when you want to buy. That's when you want to buy. When there's bad news. Buy when there's bad news. 1980. Top of the market over there, right? Went into a bear market over there. After it hit 20%, it rallied up, but could not make up 55% of the losses. Went back down again. Could not make up 50%. Went down again. Eventually, bottom at 28%. Then, it took off, closed over here above your 55% mark. Once it does, we are home free. Next one, 1987. This was the Black Monday crash featured on the Wolf of Wall Street. Top of the market. 2 months, very fast bear market. Dropped all the way down. Looks familiar. Looks like this bear market, right? 2 months. Dropped 36%. Exactly at the bottom of this bull market. Or this bear market, 36%. And rallied up. Over here, it just closed above the 55% mark. Once it closed, what happened? That's right, went down again, went up, and then home free. So again, very similar to this market. I'm waiting for this to go down, like I said, to buy more and then catch the next wave up. 1990, 1991, top of the market again. This was exactly a 20% drop, exactly Classic bear market, took 3 months, closed above 55%, we're home free. Coming closer to home right now, 1998. This again was a 3-month bear market, dropped 21%. Okay, so you can see this was the first low, right? Now, this first low, what happened? It rallied up, but could not recover 55%. So came back down again. This time rallied up, closed above 55%. And then we are home free. Year 2000, I was in the university then, just started trading the US markets. Before that, I was only trading Asian markets, right? So this was when I started trading the Dow Jones and all those US stocks. So that's the market top. We hit 20%, officially a bear market here. Once we hit the bear market, what happened? Went down, rallied up, could not recover 55%, dropped down again. Rallied up, could not recover 55%, dropped down again. Made a bottom, made another bottom, made another bottom. Went all the way up. Where's our 55% mark? It's right here. So it took quite a while to recover 55%. Once we did, made a correction over there, correction, home free. Do you see the pattern right now? Okay. This was the financial crisis where I wrote the book Profit from the Panic, made a very, very nice fortune in this market. Top over there. Again, we entered a bear market here, dropped, recovered, could not reach 55%, made another low. Total was a 57% bear market. So, ladies and gentlemen, I went through that 10 years ago. Once I went through that, nothing can scare me anymore. Except my wife in a bad mood. All right, anyway. So, since we hit that low, we recovered 55%. There, boom, we're home free. Again, did we go up in a straight line? No, we didn't. We retraced back down. And again, when this happens, it scares the retail investors to sell. That's when professionals buy. And it goes up, again, retail investors buy here. Bad news comes, it goes down. They panic, they sell. Professionals buy, and we go up again. So notice, every time the retail investors sell, the professionals like me, we buy. Right? It's kind of like they lose faith in their wife, so their wife runs to my arms. And I comfort the wife, and I've got a harem of very beautiful wives right now. Just kidding. Okay, next, bear market 2018. This was a very short bear market, only 3 months. That was a top, boom, all the way down, exactly 20%, recovered 55% over there, and boom, home free. Okay, so that was the last bear market, which was just about 2 years ago. Okay, so where are we now? All right, so back to the present bear market. I'm now looking again at the S&P 500 weekly candles. So that was our recent market top. And this was our recent market bottom here, right? So again, down 36%. Have we recovered 55%? So again, using my customized Fibonacci tool, click on A, boom, drag to B. And again, notice I customize it with my 55% level over there. You can see that on Friday, last Friday, we managed to close above the 55% mark. So based on history, probability is we're not going to make a new low. All right, probability is that we're going to go up from here. But again, like I said, we are not going to go up in a straight line. Unlikely we're going to go up, maybe come down a bit, like that, and go up and come down and and all the way up there. Hallelujah, make our next couple of million. All right, so that's how I read the markets. Now again, I'm not a financial advisor. This is not financial advice. I'm purely sharing this for educational and entertainment purposes only, just like WWE. All right, I'm just showing you how I manage my money. I'm showing you how I build a fortune in my markets every time after a bear market turns to a bull market. But you got to make your own decisions, have your own strategy. And again, if you want to watch me invest live, you want to see how I analyze stocks, you want to see how I value companies, how I watch the markets, how I read the markets regularly, subscribe to any of my courses. My value momentum investing course, stock trading course, options course, or join the Ultimate Investors Playbook, where I do all the work for you. All you got to do is to just leverage on the work I've made in order to build your wealth in the markets. So with that, thank you. May the markets be with you. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.